Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking to venture capitalists all about what they do and the impact that they're having on the startup ecosystem around the world. And with us on the line in the hot seat is none other than the general partner of Velvet Sea Ventures, Michael Lazzaro. Michael, welcome to the show.
Thanks for having me. I really appreciate it.
That's all good, man. So why don't you tell us a little bit about Velvet Sea Ventures? What are you guys up to over there?
Yeah, so my background's entrepreneur. Spent most of my career, 25 years, building businesses like you, and then found, instead of doing podcasts, decided to jump into the investment world. And I launched basically the VC firm that I always wanted as an entrepreneur, which, we're operator-led, we're multi-stage. So meaning like we've done seed deals, we've done, late-stage pre-IPO deals. In terms of portfolio, we're focused primarily on two major trends, which is digital transformation, so how tech is changing every industry, and digital ownership. So, what sometimes are referred to as NFTs, but it's really the application of the technology across various businesses. Work with my wife, Cass Lazzaro, who we have done several businesses together. The last one was Buddy Media, which we sold to Salesforce and then became part of their management team at Salesforce. And family-centric approach, hands-on support. And we do very few deals, but ones we do, we find ourselves getting involved when asked by entrepreneurs.
Yeah, so I was just looking at your portfolio. So part of your previous investments, Twitter, Tumblr, Facebook, SpaceX, Square, Salesforce. So those are some pretty awesome names to have in terms of your track record.
Yeah, we've been investing on the side as entrepreneurs for a very long time. We came up in, Web 1.0. So I had a company in the original pre.com crash, which was great, which was a company I started in college. And then we did Web 2.0, which was Buddy Media, which is how we met all these companies so early, whether it's Twitter or Facebook, Tumblr. And then as the world shifted to Web 3, we find ourselves investing there as well. And so, at the center of everything is great entrepreneurs. We love entrepreneurs. And we've been able to invest in just amazing entrepreneurs. And we're very fortunate and appreciative that they let us in as investors.
Whatever happened to Tumblr?
So Tumblr, from a company perspective, was sold to Yahoo for $1 billion. My hopes for the company when we invested was really, we didn't know about Instagram, but it was Instagram. I mean, every high school kid was decorating their Tumblr page. Like I used to decorate my bedroom, right, in like grade school and high school. And Tumblr was a visual platform. It was a creative platform. David Karp, very young CEO, founder, who was a designer. And he built a great product that then was sold to Yahoo, and it's still around. It's obviously not as big as it once was, but it's still a product that exists.
Why did that acquisition fail? There's this CNBC headline: how Tumblr went from a $1 billion Yahoo payday to a $3 million fire sale. Why is that? Like, what actually happened? Do you have any insight into that?
I don't. It was a long time ago. I think companies, strange things happen when companies buy younger companies and don't focus on the integration. So one of the biggest part of my deals with Salesforce was really a focus on, how does our team work with their team and how do we become one team? And many of my partners and key lieutenants are still at Salesforce. People like Patrick Stokes, who's an executive vice president, who's my CTO. I wasn't involved with the Tumblr integration, so I really have no idea. But let's just say it's not a huge surprise that it didn't work out great, given if you've read about what has happened really since then with Yahoo.
Yeah, it's true what they say, right? Startups go to corporates to die.
Not always, but if you don't focus on them, it's not that they die. You often lose the entrepreneurs. And so the beauty of working with Mark Benioff at Salesforce was he's an entrepreneur, and he basically said, listen, we're buying you guys because of the people. We want you to be happy. If you're not happy, that's really on you. If you don't like what you're doing, do something else. We want your blood here. We want kind of that entrepreneurial spirit. And it's why I spent 4 years, and it's been such a successful, acquisition for a lot of my people who I worked with at Buddy Media. Salesforce has done a really good job of, becoming a place where entrepreneurs thrive. And if you look at many of the leaders there, they start off as entrepreneurs, as builders.
So what makes you guys different? I mean, how is it that you guys have become so successful, and what else do you do like value added investing? How have you been able to be so successful as a VC firm?
Well, we're a young firm, and so I appreciate the question where you assume we're successful. We feel like we're still building a business and working. So we'll see what happens. Very happy that one of our larger relationships announced a sale last week. So Scopely is a games company that I personally helped seed over 10 years ago, and then became one of our largest positions. So that company announced a sale for $5 billion, which we're super excited about. We've only been in business for about 3 years at the firm. And so, really, what we do is we are who we are. So it's a husband-wife team, father-son team. We are builders. We're entrepreneurs. We try not to be anyone else. And so we made our first investment August 2019 as a firm, which was Scopely, which was the company that announced the sale. And we came to the firm with over $2 billion of deals that we'd done personally. So over 200 deals we'd done between, the partners. And, those 200 deals were with, over 60 founders, and they built really big businesses. And so we've just seen a lot in terms of when you run companies for 20 years, you pretty much see everything: hiring, firing, cycles. We raised $100 million at Buddy Media and thought we were going public. My first business ended up going public. We have sold companies, we've bought companies, we've hired the wrong people. So we kind of have seen a lot, and we try to help. So we don't call our founders proactively to be a pain in the ass, but we say, hey, what are the hairiest things on your plate? What is the stuff that's keeping you up at night? And how can we help take that off your plate? And typically that comes down to hiring the right people. So, hey, I need a chief revenue officer. I need to up-level my customer success manager, whatever the thing is. My wife operated all of our businesses. I was more of sales and marketing and product development. And so we've hired CFOs, we've hired chief marketing officers, literally hired, lead the search, interview the people, tee them up for the founders. We help with fundraising. So our seed deals, they're oftentimes young founders who haven't gone through the fundraising process. So it's not only helping them tell the story. I'm a journalism major, went to Northwestern, kind of love content, love stories, but it's also introductions. So warm introductions to the investors who we think would be interested in, the specific companies. So, I think that's, if you talk to our founders, the differentiator is we go to work. I was with one of our founders in New York yesterday, bringing them to meetings, and the co-founders, business partners said, you do this for all your companies. This is I would pay for this. This is incredible. Meeting after meeting, that were warm intros that were ready. And so, we judge our success by by that relationship with entrepreneurs. They think we're helping. Are we being a pain in the ass? I've worked with dozens of investors that are not all great. So, we try to stay out of the way. Worst case scenario, we do not want to be a pain in the ass. And success breeds success. So like, we've had a lot of success as entrepreneurs. We know we've employed hundreds of people, thousands of people. We know a lot of people who are winners. We think that winners win, and everyone else just explains things away. So if you're looking to build a team, we often either 1 degree or 2 degree away can help with, with getting the right people. And that's really, in terms of the venture business, people always say it's about the people, right? Oh, it's all about the jockey. You hear this again and again, the jockey. But it's really about the 10 hires you make to start. It's about who scales. How do you build the team as the company evolves? Hopefully grows, but if it doesn't grow, obviously you have to make some changes. So that's kind of what we do.
Okay. So what's a typical check size look like? I mean, are you cutting $1 million, 10 million, 5 million? Does it vary? Where's the sweet spot for you guys? And I'm assuming you're looking at like revenue generating companies and that kind of stuff. There's traction on the business model. Is that kind of where your sweet spot is?
Yeah. So 80% of our investments to date have been in revenue generating companies, not always profitable, but companies that have, figured out product market fit. So they have customers. They're happy customers who do a lot of diligence before we do the deal. They're renewing. They're buying more stuff if it's a software company. And that's where we put, most of our kind of large checks. And those checks, I think the sweet spot is really 5 to 10 million. But we've gone up to 50 million through not just through the fund, but we, our LPs, and we like, scaling investments that really are doing well. So companies that really break out, we can help them raise a boatload of money because we know the companies, we know the investors who would help. We also do, our smallest check is 100,000. We don't want to be, what I used to hate as an entrepreneur is you show up to these VCs and be like, I love you, love the company, love the space, but we need to be able to put in 10 million, 5 million to like work with you. And that is something that I think the amount of money that's been lost in the VC business because of that approach has really led the smartest firms to move either up or down in the kind of stage level. But it lets us take with primarily, you see the seed deals and some of the earlier stage deals with known quantities, entrepreneurs we've worked with, or people who've had either success or built something. And we're like, yeah, we want to be a part of that. And is it going to return our fund a $250,000 investment? Maybe. Let's build something big. But when you need the Series A, the Series B, the Series C, we're there. And we've done, we've only been in business since really end of 2019. And, we look at a company like, Carta Health, which is near and dear to my heart. It's virtual cardiac rehab. I have an artificial heart valve, and they're basically doing Peloton for that space where you can do cardiac rehab from your home through kind of telemedicine. And it's a company that we seeded, we helped bridge, we led the Series A. We think that shows strength for a company. We don't think that shows weakness, that, they couldn't raise outside capital. Like, yeah, they could have raised because we brought other investors with us. And so we like being the financial partner to our companies. So when it's time to raise, we may not write $100 million check, whatever, but let us help you navigate that and stay off the road and focus on your business. And I think we've done that well with some of our early companies like, not like Carta, but Liquid Death, which is, the water I have right here, which we were, as part of the seed. And then we did Series A and part of some of the late rounds as well. So we want to be there for entrepreneurs when they need it, because it's really a miserable job. Like being a founder for the first few years, it's a series of no. It's just getting hit in the face over and over again. And so like, how do we support them so they get to yes? And then all the fun starts. You get calls from inbound calls from clients. You have employees who want to work for you, right? So, and that's our goals, going from oh, you don't exist, no one knows about you, to, it's a really exciting place to build a career if you're looking to move as talent.
Mm-hmm. Well, that's amazing stuff. Listen, where does it go wrong? You get pitched a lot, and so I'm curious to understand, where does it go wrong for you? Like, what are the typical commonalities that you see in terms of, if you think about the last 100 deals you said no to? Why?
Yeah. So we say no to most deals. So, out of the, several thousand deals we get a year, we may do 8 to 12. Depending on the time, right? Like, things have changed. When we launched 2019, interest rate 0, money's free, tons of deals. Right now, the cost of capital has gone up, right? People can make very easily 6, 7, 8% with minimal risk. So the venture world reflects that. You're not seeing the crazy late stage valuations. You're not seeing, the frothy public markets. Typically, we say no for 2 reasons. One, the industry. So we try to do stuff that we know, stuff that we could help out with. I spoke to a biotech company today. I love it, but I don't know what I just can't get there in that space because I'm not an expert, right? And so, when we talk about industry, although we do various industries, we have to know it, and it has to be really, really large. I've yet to see a very large company come out of a tiny market. They may exist. I'm not saying I've done all of the research, but if it's a tiny addressable market, and I'm not saying like the overall market, I mean the addressable market. I used to be in the golf business. We owned golf.com, and $20 billion market. But when you really take out tee times and travel and everything, it's like $1 billion market. Less, really, because we're not selling golf balls or clubs either, right? So if you look at just at that business, golf media was maybe a $200 million market, which is a mistake that we made early internet. Like, why'd we even start that business, right? Kind of stupid. And so market is so huge. And I think what we learned through Buddy Media is we picked a really good market at the right time. So we didn't invent social media, but we helped onboard a ton of big customers. So 9 out of the 10 global marketers bought our software and used it to do their social media marketing. That space hasn't turned out the way I'd hoped. So that was before Facebook and others were viewed as cigarettes and so toxic and destroyed democracy and everything else. But we'll save that topic. But that was a big market. The whole world shifted. And so it's why we love Web3 and digital ownership. The idea of owning stuff that's digital, recording identity and other information to the blockchain for perpetuity, soul-bound tokens, all the stuff that's going on. I think we're I think we're at the end of the beginning, which is what happens with these cycles. They kind of like very frothy. They crash, like the dot-com crash in 99, or, the economic crash of 2008 when we started Buddy Media. And then the real building begins. And so I think, and then the other reason, so market, try to answer your question, sometimes all over the place. Market is why we say no. And then the team, like, is this the right team for this opportunity? And most of the time, we don't think so. Like, do they know the space? Do they know the problem? Do they have contacts in the space? Have they experienced the problem that they're attacking? Have they shown that they could build? Have they shown that they could lead? Can they hire people? Can they fundraise? And we spend a lot, I would say we spend a lot more time on that early on. Once like, a company like Scopely does 100 million of sales, and it's way beyond that. It's kind of like, okay, they built something real. But a company like Carta Health, Harry and Andrew out of University of Pennsylvania, focused on this very technical business. They had built businesses, they had built projects, and then and that's really it. Because if we have a great founder in a great space, the business model that's pitched to us early on is probably going to change. Like they don't know. It all looks good in a spreadsheet. Like then they start operating and they get punched in the face 100 times. And they're like, okay, this isn't working. And so, yeah, we're not that. We are traditionalists. We look at unit economics. We look at margins. Like, can this be a business, right? Like I've seen when you've been doing this for so long, really my whole career since the 1990s, you've seen a lot of businesses that the economics are upside down. Like the more money higher the revenue, the more money they lose, right? Which was a story of a lot of these companies.
Yeah.
Try to stay out of that business.
Understood. And so, what has been your greatest success and failure, would you say, Michael, and what made the difference?
Yeah, I mean, the biggest success today has been on the entrepreneurial side. I mean, selling Buddy Media for close to $1 billion after, getting to about 50 million in sales after 3 years. We felt really proud of that and the team that we built and the culture we built. So we look at that as kind of, and when I say we, my wife Cass and I, as kind of the biggest success. And on the investing side, I think it's what we love is companies that we are there at the beginning. Like there's this concept of like venture is a pack animal business, right? If all the investors think it's a hot deal, like they all pile in. And we really pride ourselves on being first and doing our own work and leading rounds. And so, honestly, Scopely is a company that I just sent the founder, Walter, his message that he sent me in 2011 saying, hey, I think games are going social. I'm going to build like a free-to-play social game company that really looks more like a social network than games, where people hang out, they play together, they get to know each other. And then fast forward and to hear, to get a call from a founder saying that like, I've signed a deal. I mean, I knew what was going on, but like we've signed a deal to sell the business for $5 billion after seeing it on, like that is super rewarding because the amount of like stress the founder has been through over the years, like financing the company, buying companies, hiring, firing, and being there with them. We find ourselves getting a lot of calls because we're like entrepreneurs, right? And so, we were there at the beginning of Scopely, we were there at the beginning of Liquid Death, which is now a national brand, soon to be global brand that, they're a private company, but let's say they're selling hundreds of millions of cans of water and now iced tea, which is delicious. I would recommend that. 30 calories, very low. But I'm not recommending it as an investment, as an iced tea. So those are our biggest successes. And then I think failures, we're constantly, going back to our biggest failures. And I'm not going to talk about the company specifically, but it's when we think we can operate the business. And so we look at the investment through the lens like, oh, we could do this, and don't focus on the founder. Because the biggest difference between what we used to do for 20 whatever years and the last 3 full-time professionally, but really the last decade, off our own balance sheet, is just assuming that founders are going to be like us, and they never are, and they never should be. They should be them. And, as investors, we don't do a lot. Like, we work for the founders. It's not the founders don't work for us. Give me one thing that is impactful that we can do for you, and we'll do it. So Carta Health, we just had a board meeting recently. They had asked me, like, we'd like to redo our content to make it more engaging for the people going through cardiac rehab. I happen to know the fitness space and fitness content, so I sourced the company that did the content, and it turned out great. And the founder's like, hey, that what you did there in that intro is like affecting every patient that comes through. You'll like touch the work you did, right? So it's like that sort of mentality of like, I work for you. Don't give me too much to do because I got a lot of companies, right? But give me impactful stuff that matters, that really no one at your company can get done like effectively. So it's like kind of specialized stuff, but it's like hiring. Hiring's the biggest one. Like one of our companies just brought on board one of my key lieutenants from Buddy Media, and it'll be transformative. It's a revenue position, running all like global revenue. Person's done it for small companies, for Salesforce. That is the single best way as an investor that you can help your companies. And, you know, what I love about the venture business is we all make money or lose money together. So it's not like I'm, you know, when Scopely sales and when it closes, like we're all going to do well. Like if it doesn't do well, none of us do well, right? So I love seeing founders succeed. I love seeing founders get rich. Like I'm a capitalist, right? Like, yeah, it's a better way to spend your day, even though it's miserable, like building. However, we're doing it to make money and to support our families, right? And I don't think that's a bad thing. I think you can make money and do good at the same time.
Michael, just a few more questions. When you think about the future of venture capital, what keeps you up at night? Think about SVB and the banking issue, market, the macroeconomics, all that stuff. What do you hang your hats on there?
Well, what typically goes wrong is stuff that doesn't keep me up at night. I don't know if you've noticed that. Like, you know, these are things that like I'd never thought of. I'd probably sent 50 entrepreneurs to SVB, right? Like I've worked with them for 20 years. They've sponsored all my events. Like they've done, I remember when they launched the venture debt product. So the venture business as we know it, I think is broken. And I think what's broken is this constant cycle to raise new funds. And it's a misalignment of interests. Like, you know, you just raise funds, you invest it over 3 years, you raise more money, regardless of the environment that we're in. And so what we're really focused on is how do we be efficient? How do we make the most of what we have? We don't want to build the biggest platform, right? Like we're all partners. You don't work with a junior person at Velvet Sea. You work with a partner who is there for a reason because they fought for your deal and invested on behalf of the partnership. And a lot of I should have said a lot of the money that we invest is our money. So all of our venture capital investing goes through these vehicles, both families, GM Petronis and Lazarus. So, you know, and we're aligned with our LPs, and our LPs are, you know, people who look like us, other entrepreneurs, executives, and VCs. So we're not, you know, we're not looking to build a multi-billion-dollar like underlying platform. We're looking to have small funds that can scale up, you know, when needed, right? So we could write a $50, $100 million check, not just out of the fund, but our LPs love that, right? Because they can put more money into the winners. And I just think that, like, you know, creating a venture, it happens to be what I do, this stuff, right? Start and invest in companies. I would never recommend anyone start a venture firm. Like, it takes forever. Like, so when you look at a Scopely deal, like, that was 2011, right? I was young. I didn't have this like gray hair. I was, you know, had energy. Like these businesses to build something that's meaningful. It doesn't happen overnight. So Walter Driver at Scopely is a, you know, 15-year overnight success story, right? Like doing the right thing every day to build this thing. And that's like a long horizon, unlike a lot of other investing, which is more liquid, you know, capitals flow in and out every month. You Yeah, it's an odd little business that we are in.
Yeah, well, you should try starting a podcast. I also
Who
wouldn't
knows?
recommend that to anyone.
I have all the respect in the world for people who've built real platforms like you have, and I know that it hasn't been easy. I can't even imagine what went into it.
Yeah, it's next level. I'm doing like 100 shows a month at the moment. It's quite a thing. It's quite a thing.
You look like you have energy and that you love it. Maybe you don't, but that's pretty impressive.
I've wanted to quit many times in the last 9 years.
And why not? What happens?
It's like, why am I doing this?
And what's the answer?
There you go.
What's
I get a good
answer
answer. Oh, yeah. To make a difference, basically.
Yeah.
That's pretty much, and also to learn and to build a network. I've got an amazing network, and it's a weird thing. Like, people always want to talk about their perspectives, and it's a very powerful human insight. Like, it's actually, it's the best thing I've ever did in hindsight. I've wanted to, yes, it's hard. Yes, I've wanted to quit a lot of times, but in the same way, like you're saying, Michael, around like startups, it's also hard. It's also, it takes a long time to become, 15 years to become an overnight success. And yet you do it anyway, because you just can't see yourself doing anything else. Yeah.
I mean, that's I don't know if you invest personally, but that's what we look for. And frankly, a lot of our friends, that's who they are. I mean, these are people who've dedicated their stuff to their, whatever the vertical that they're in. Some have become billionaires. Some are still, trying to make it happen. The constant is the misery that goes into it every day. And unless you have the fire to keep going, a lot of us, I don't know about you, but I'm driven by the rejections. So I have, and I'm happy to show you, about 60 rejection letters going back to my college days. I got rejected from 4 colleges. I got rejected from about 50 internships. And I just collect them like those. And they're like, now they're like gold to me. They're like, reject me, and you were forever in my, near my desk.
Yeah, it's funny that, right? Like, it isn't the story with Peloton, same thing, got rejected, I think 400 times. Airbnb, no one's ever gonna want to share their home, with strangers, and I think it's almost like a defining characteristic of someone who's actually built something of noteworthiness. It's having.
I think that drives, like, for me, like, the fear of failure drove me a lot more, and still drives me a lot more than the kind of quest for success, right? Like, I'm much more driven by, like, that's not a fear, but, we all have kind of imposter syndrome, right? I'm new as an investor. I tell all of our LPs, like, I could suck at this. I think I have good deal flow. I think I can help grow companies. But that idea that I'm going to take for the first time 3 years ago someone else's money and try to turn it into more money, right? Like babies, like money having babies and create more money. I didn't know. And so that's what drives me to work hard every day, is that responsibility, in a way that when I was just investing my own money, it's easy to say yes, right? Like, how do you get to do like 100 deals? You just say yes to entrepreneurs. When you take other people's money, it focuses you very fast. Even though a lot of it's our money, it's there's a seriousness to the diligence to, like, the work we do that I think is important. It's made me a better investor.
Which investment's given you the greatest return? If you think about Twitter and all the other ones we mentioned up front, what is there a shining light? I mean, obviously, I'm the insight here on this question is that you get 95% of your returns from 1 or 2% of your portfolio. So which one has led you to getting the greatest returns?
So, as I said, I'm driven by, like, that fear of failure. So I should know this, and I'm actually, like, embarrassed that I don't know this. We've had 40 exits, I think, over the years. And there's some, like, $100,000 investments that did incredibly well. They're $1 million investments. we're not, I mean, what's interesting is like, I don't believe that. I don't believe the idea of like a third, or like a third will go out of business, third will be like whatever, you'll get your money back. Like we go into it assuming everyone's going to be like a home run. We have had companies go out of business, but it's very rare like to just completely go out of business. Because if you've raised multiple rounds, you've built something. Yeah, so it's a good question. I really don't know. And I'm a registered investment advisor. I wouldn't want to say anything that's like not true.
Yeah.
But we've had a lot of success, a lot of failure. What I love, like I remember years ago, I'm like, listen, we can only lose the amount of money we invest. So we could lose, like, we invest $1, we lose $1. But we can make like a lot of more, right? If we build something real. So like that idea of like, you only lose what you invest, but you can make like 100 times on an investment. Like, I love that. And I love that because I feel like I've operated in this space and I'm not playing a game that I have any sort of unfair advantage. I just have a competitive advantage because of signaling and knowing buyers and knowing bankers and knowing people. Like, you know, I've worked with the same people again and again. I had breakfast yesterday with Howard Lindzon, who's another podcaster who was in town, you know, and we basically are celebrating coming up on celebrating our 20-year anniversary of working together, right? Like, you just end up doing, you know, you work with the cast of characters who you work with in every industry. And I think that is why I'm fired up. I can do it without the misery of running companies, which is like, it's such a hard thing. And we have so much respect for people who do it.
Yeah, it's interesting that a lot of the guys who do venture capital, pretty much all of them were entrepreneurs, sold their companies, and then for whatever reason, they decided not to start another company. They were like, no, I'm going to take my wealth and I'm going to put it into other companies and avoid myself the suffering and pain of of having to go through that. Why did you choose to do that? I mean, if you clearly you know how to scale things. I mean, if you could be less risky, say. I mean, obviously, if you could back your own startup, you grow the thing again. You know how to. It's a formula that you figured out, right? Buddy Media and so on and so forth. You didn't have to get into venture capital. You could have just done it again, or maybe not. But I'm curious, why did you choose to do venture capital basic, given the fact that it is so risky?
Yeah, so we made a specific, and when I say we, you know, my wife and I are very connected on work as well as like our 3 kids and dogs and everything else. But there's no kind of first, second, third gear when we start a company. We're all in, and frankly, it's just not that healthy. And you know, I have an artificial heart valve. I have to watch my health, and we could say that we're going to do it differently, but I know we wouldn't. Which means you are eating poorly with clients, which is like the story of like Buddy Media. Like every night I'm out. I went years without seeing my kids' teachers or even meeting them. And there's just collateral damage to our life that we felt like we had PTSD coming out of it. And so I went to Mark. I said, after 4 years, Mark Benioff at Salesforce, I was working really hard. Like Salesforce, people work. Like it's not a company you just go and like sit around. And as we thought about what would work for our health and our life, we turned to investing. Having said that, our kids are 2 in college, 1 in 10th grade. You know, for the first time, I'm like, maybe who knows? Like maybe there is another company in us. So I wouldn't rule anything out, even though there's 100% no plans to do anything. But it's just a tough life going from 0 to 1, and it takes years. And then once you start once you're on the investment side, I think what we realize is like the highs aren't as high, the lows aren't as low. But a lot of what we loved about building companies, we get that like adrenaline hit, and we could stay relevant and keep the beginner's mind and stay sharp and have purpose, right? Have a reason to get up in the morning to do stuff that I think is meaningful. And is it better? Is it worse? Like, life is trade-offs. And and we're glad we built this firm, but it is another business, right? Like, we have a general counsel and a CFO, and, we have LPs, and we do investment letter. Like, we had to raise money. We had to create a product that entrepreneurs would like so we could like deploy the money. And then we have to store it so we could like generate revenue or returns. So in many ways, like, it feels like a business. It's just like an easier business to operate because we don't have 1,000 employees.
I understood. I think it's. I think with whatever choice you make, right, you're pretty much betting on if like a 10-year cycle of suffering. You got to figure out what kind of suffering lights you up.
It's
Otherwise,
like pick your poison.
You know what I mean? Like, pick your struggle, brother.
And that's like, what's interesting is like that concept of like, I would rather know my pain than the unknown of like the pain, right? Like, I'd rather be able to pick my poison than have it pick me. And so I think the downside of investing is like, some days I feel like I have 100 bosses, right? And I have all this stuff to do. But the upside is, it's like, ultimately it's on them. Like, I'm here to help you, but it's your company. And and one of the conversations I have with founders is like, I don't want to hear excuses that you have like bad investors, or we fucked you up, or we had expectations. It's like, no, we want you to succeed. You know your business better than we do. Tell us how we could help. Tell us how things are fucked up so we could help. But there's no, like, just because you present a budget in November for next year, and then you come into January and you're like, oh, we're not going to hit this budget. Like, we're not going to be upset. Like, we've seen everything, right? Mm-hmm. I've had a company who had like a Russian oligarch as a majority owner, and I had to like unlock the cash in the bank because it was like seized by the Treasury Department, right? Like, we've seen a lot of stuff. We don't like surprises. Mm. We don't like lack of truth. We don't like hiding anything. So like, we always say, like, don't shine the turd. If it sucks, it sucks. Get it out there. It's going to eat you up inside. It's going to eat the company up. Like, deal with it today. Don't kick the can down the street. That's where we've had the biggest disappointments, like founders who are like trying to like make the optics look different, right? And it's like, hey, if customers aren't buying your stuff and they don't like it, like, do something else. Like, do more of what's working and less of what's not working. Mm. Like, a lot of this is just not. It's just, a lot of it's common sense. Like, and what we've realized is, and I think we knew it, but like, I think Mark Benioff really showed us, like, it's, when you look at what you do, there's a string of things, but what people remember, whether it's like investors or employees, it's like how you operate. Are you doing the right thing, right? Are you treating people well? Are you communicating clearly? Like, that how you operate is as important as what you do. Because eventually, even the largest companies that didn't really, their how was a little messed up, it eventually catches up with you, right? Mm. And then you have to figure it out. Like, I think, that's some of the companies you've mentioned. You look at Uber, if you look at some companies that were kind of like not the way some of the people were operating, the how, they didn't get right. So really focusing on what's that operating system that like you're using. And, one of the ones that Mark Benioff would say all the time, it was a smaller company. I was working closer with them at the time than maybe people do now. Was just like, do the right thing. Like, you'd ask them questions like, what's the right decision? Like, forget what's in the contract, forget what this employment, like, what is the right decision? However you define that. for the people involved, for the business. Do the right thing always. And I think that, it requires playing the long game, because oftentimes it looks like there's easy money or there's like shortcuts. Whenever we've done something because of money, just because of money, it's usually, been suboptimal.
Well, on that bombshell, Michael, doing the right thing is always the right thing, as they say, and you're obviously doing the right thing more than most. So,
trying.
Congrats on everything that you do, man.
Thank
you're
you. You too.
Cog in the venture capital ecosystem, and your success obviously breeds more success. So, thank you for being on the show, man. I really appreciate your perspective.
No, thank you. I appreciate it.
Anytime. Thanks, everybody.
Yep.